A very common sales pitch amongst the active management community is their ability to provide downside protection for investors in falling markets. Seeing as most investors remember the Great Recession all too well, this type of language can sound very attractive. Unfortunately, that sales pitch is complete fluff and not backed by any sort of empirical evidence. In fact, the complete opposite has been observed more often than not. Jason Zweig of the Wall Street Journal points to analysis conducted by Rui Dai from Wharton Research Data Services. Looking at the University of Chicago's Center for Research in Security Prices mutual fund database going back to 1962, Mr. Dai found that the odds of finding a manager who will preserve your capital in a falling market are slightly worse than the flip of a coin. If we just focused on the last two significant market contractions, we can see that Mr. Dai's comments ring true. During the bear market from 2000 to 2002, the S&P 500 lost 43.4%, while the average fund lost 43.2%. The housing crisis from 2007 to 2009, the S&P 500 lost 50.2%, while the average U.S. stock fund fell 49.7%. If we go even further back to the market crash of 1973-1974, when index funds weren't as common as they are now, the S&P 500 lost 37.3%, which was the largest market contraction since the Great Depression. How did the average U.S. stock manager do? Worse. They lost 38.9%. This isn't the first time a study has been conducted on this topic. In the fall 2012 edition of the Journal of Investing, a paper entitled Modern Fool's Gold, Alpha in Recessions, researchers Sean Pfeiffer and Harold Avensky examined the fund performance of 1,115 active fund managers for the 20-year period between August 1990 and March 2010. They used CAPM, Fama French 3-factor, and Fama French Carhart 4-factor asset pricing models. According to the National Bureau of Economic Research, there were 3 economic recessions and 3 economic expansions. On average, active managers displayed a negative 0.85% alpha across the entire time period, a negative 0.41% alpha during recessions, and a negative 0.81% during expansions. Active management relies on the premise that there is always a winning and losing side to every trade. In every trade, there is an active manager who is looking to sell and an active manager who is seeking opportunity and looking to buy. That doesn't change because the market is up or down or sideways.